Everyone, and welcome to this Wednesday edition of FreightWaves Now. We're going to talk to brokers today about potential scaling headwinds and also shippers, something about negative interest rates. But first up, we're going to go to the carrier update presented by AT&T Business. Welcome to your carrier update presented by AT&T Business. Today I wanted to talk a little bit more about what the potential trade concerns have done to supply chains and the redistribution of freight across the country. Behind me I have the outbound tender volume index for the Newark or the Elizabeth, New Jersey and the Los Angeles markets. You can see on top, this is Los Angeles. This orange line is Los Angeles outbound volumes. They started off very high, but have started to kind of moderate as we go into the third quarter. And this is the peak season for Los Angeles, so we should technically start seeing these volumes start to increase again. The Elizabeth, New Jersey market on the East Coast has started to really increase. We've seen a huge surge of volume coming out of the ports there. And that's because a lot of the shippers overseas have started to redesign their supply chains. If we go to my next chart, we're going to see a map of China. This is where a lot of our volume comes out, and it comes all the way across the ocean, hits the port of Los Angeles, and then gets on some form of surface freight, either rail or trucks, heads into the country. A lot of that freight does go over to the East Coast. But you see what happens all the way up here in Shanghai. Once all the shippers start to move out and further south, down here into Vietnam, Ho Chi Minh City right down here is one of the biggest ports in the southern part of Asia. Malaysia's further down here to the south. What that does is it changes the mileage, the distances to the East Coast and the West Coast. Now there isn't a significant change of distance from the East Coast to the East Coast from Shanghai to Newark, but there is a pretty big difference from down South Asia to Los Angeles. It's about a 2 to 3 day increase in transit time. But there's only about a half-day increase in transit time going from Southern Asia to the East Coast of the United States. So what that's done is it's made the East Coast freight a little bit more attractive to push through the Suez Canal going all the way to the East Coast. And the volumes themselves have started to really show that. You see the Port of Savannah, Houston, Miami, they've all had increases as well, but none more than the megalopolis around the port of New York and New Jersey.
Improve your fleet's efficiency with AT&T Fleet Complete, a 4G solution for tracking vehicles and simplifying ELD compliance. AT&T Fleet Complete, delivering fleet solutions for every business.
Welcome to FreightWaves Weather for your Wednesday. Hope you've had a great week so far. Hope the weather hasn't got you down too much because we're going to be having problems again in the Northeast. Rough weather for drivers along the I-95 corridor today, especially late this afternoon and into the evening, but also for interior portions of the Northeast and New England. We're talking about from Maine, New Hampshire, all the way down to Boston, New York City, and into Philadelphia. And right now, there are 4 markets in the severe weather risk zone today that are combining to produce 10% of the nation's outbound volumes. That's Philadelphia, northern New Jersey, also Allentown, Pennsylvania, and Harrisburg, Pennsylvania. So it's really going to be rough going. We're going to see storms producing, beginning especially later today, producing a lot of heavy rain, possible flash flooding, large hail in a lot of spots, and also scattered areas of really intense winds with these storms. Now, it's the opposite story as we head out towards the desert Southwest, where it's going to be very, very dry and still really hot too, from Phoenix up near Flagstaff, Yuma, Arizona, all the way up to Las Vegas and into interior portions of southeastern California and the desert areas. Actual temperatures will be topping out again today at around 115 degrees in a lot of spots, and some of the hottest spots could be getting up to near 120. Phoenix yesterday topped out with a record high for the day of 113 degrees. And across Texas, the Central Plains, not quite as hot. Temperatures will be well into the 90s over into parts of Arkansas, western Tennessee, northern Mississippi as well. But the difference is it'll be really, really muggy from the Central Plains and into the lower Mississippi River Valley and the Tennessee River Valley. So the heat and the humidity combined is going to make it feel like it's about 110 to 115 degrees in some spots and 105 to 110 across a large chunk of that region. So again, drivers just spend as little time as possible outside your trucks. When you do have to be outside, just drink lots of water, try and stay as cool as you can. Third thing we're going to talk about today, way out in the Atlantic, we have the third named storm of the Atlantic season. This is Tropical Storm Chantal, which has winds of just 40 miles per hour right now. It's probably not going to get a lot stronger. It's not any threat to land right now. It's just going to kind of wander across central part of the Atlantic Ocean for the next few days, but it will be a concern for at least some cargo on ships, some of the ocean cargo and that freight that's going to be coming across the Atlantic. They'll have to steer clear of the storm over the next few days. That's what you need to know for your Wednesday weather. Be sure to subscribe to our YouTube channel. Have a great day and be careful out there.
Up next, we have Kevin Hill giving us some outlook for brokerage in the next several years. So Kevin, what do we got?
What we got is the total addressable market, or TAM, for freight brokerage over the next, say, 10 years, up until 2028, kind of how the industry is expanding.
So how big can it get?
How big can it get?
How much of that slice of that pie can you get if you're a brokerage?
Exactly right. We're going to look at that, the overall pie, and then the margins. Everyone loves to talk about margins, right?
Yeah.
But first, let's really define the trucking market. So we have North American logistics. Okay. Here, the transportation piece is about $900 billion, right?
That's a lot of money.
It's a huge.
Yeah.
It's about, 8% of GDP, right?
Yep.
On the trucking side, you have about $750 billion. I think it was a little bit higher in 2018 because of the rates.
Right.
But generally, it's about $750 billion, but that's not really the freight broker piece of the pie, because a lot of private fleet transactions are included in this, but you don't broker private company transactions, right? You know, Walmart products going to Walmart.
And your Cokes, they have fleets of trucks.
They have fleets of trucks.
Included in this number.
So basically right behind you here, we have the for-hire truckload market, which is about $350 billion, right? And that's what brokers broker.
There you go.
So if we go to...
For-hire truckload, and then right below that?
Oh yeah, we have brokers, sorry.
$62 billion?
$62 billion, I forgot all about the brokerage market. So right now it's about $60 to $70 billion on the freight brokerage, and that represents about 18% of all trucking transactions, right? And we can see that right here. In 2018, $62 billion, and we kind of forecasted out using a model. It's pretty aggressive, I will say that, for the next 10 years and how brokerage is going to grow that pie. And we come back over here to just under $180 billion in 10 years. So it's a nice CAGR, 8-9%.
Standard kind of growing. That's a good clip too.
It's a very good clip, because if you think about the economy, it grows at about 3 to 4% on high years. Let's just really say about 2 to 4%. 2 to 4. Four is probably on the high end of that growth. Very high end.
And you're talking about 8 to 9% for the brokerage.
8 to 9, so double.
Pretty aggressive.
It's been for the last 20 years. It's been double GDP.
Right.
I think it's going to continue to double on that.
Okay.
So as we grow, we're going to get to about 30% of transactions are going to go through brokerages instead of 18% today. So almost double.
Okay.
Right. So and yes,
and we got something.
Talk about margins.
Yeah. This is the
Everyone
interesting part,
talk
right?
About margins.
But this line's going the wrong direction.
It is. So we took the TIA 15.1 or 15.7% average margins right now. And those are going to decline as the market grows up and probably get down to 10%, maybe high double digits. And why is that? It's because of technology, efficiencies coming into the market, the digitization of freight, and increased competition in the market.
There's going to be a lot more people. I mean, growing at an 8 and 9% clip, that's going to be an attractive industry for people to enter.
And that's exactly what you're seeing, especially with the VC-backed firms who are digitizing freight, right? So in all freight brokerages, top 100 down to your mom and pops, are going to have to include technology and become more efficient to operate, get higher gross revenues, because these margins are coming down over the next 10 years.
So they're going to have to get a little bit more competitive. I'm here with Craig Fuller, who back on May 23rd called a freight recession. So something has changed though, and what are we looking at, Craig?
Yeah, so on May 23rd, we were talking about the really big dip that happened in the market in 2019 that was counter to a typical trend that you would see. And this is actually it. You see this massive drop, this blue chart right here is the 2019 market. The yellow is the 2018 market. And so actually what's interesting is the yellow follows a typical seasonal pattern, even though there was acceleration in the market. There was a lot of demand in 2018.
2018 was what everybody called an overheated market.
It was an overheated market, but it was a typical cycle. Where it was overheated, it was overheated in normal seasonal patterns.
Right.
2019 has been completely different, and it really sort of caught our eye in mid-May. So if you look at this, it was sort of the peak of that cycle, and it completely dropped off. This is volumes, our OTVI index, which measures a total amount of volumes of loads in the market, demands for trucks or asks for trucks. And what you see is Donald Trump tweets, we have tariffs implemented on May 9th, you see the drop off, and a lot of that was just port activity. People were just controlling how they were managing their supply chains and changing the patterns of freight movement. We saw a huge drop.
It's almost like shippers took a pause right here and said, we don't know what to do.
They did. Right? I think a lot of it just had to this sort of reaction to the market of not knowing, do you fill up inventories? Are we headed into recession? There's a lot of uncertainty that took place in the month of May. And if you look at the public truckload carriers and the LTL carriers, a lot of the folks in the market talked about real softening conditions. ATA came out and talked about softening conditions after we did, talked about May and June being really soft. DAT came out in mid-June and talked about the fact that they saw softness. And what was interesting was all of it was affirming that the May number and the June number were really soft. And you see that.
Yeah, and this was about 6-7% lower year over year?
It was about a 7% drop from where we were at the peak to the trough. These big dips that you see are just holidays. That's Memorial Day. But if you move into June, you see there was a big gap between 18 and 19. So this yellow is just showing how big of a gap. And we actually saw in later part of June, where you typically see a run-up into July 4th, you actually saw the drop-off happen faster than typical.
Yeah, earlier. So earlier seasonality. We had the seasonality that we normally see, but it was not as severe as we would expect.
You would expect it sort of to have an acceleration at the top. You didn't. Now, I want to talk about what happened in July, because this gets me excited. So on, I believe it was July 29th, 30th.
24th.
24th. Well, we saw the drop, but I think on the July 31st, we came out and said, the market is recovering. We called, is this happening? We said, is it? We did it here on FreightWaves. And that took place right here. But what really was interesting was this directional change in the market from 2018 to 2019. We actually saw a golden cross, as they like to say in technical analysis trading. The golden cross happened right there, and you see a breakout in the market. Now, the question was this just some noise in the data? Was just some volume that was atypical because it's hard to track, or is this something sustainable? We weren't sure, but we were certainly encouraged. And what we've seen is that gap has continued to stay. We've not seen it converge again. We've not seen them dip in.
And we continue to see it diverge even further.
This is even more encouraging because what we're seeing right now is that the 2018 number is showing deceleration, likely about the time that the market had peaked and was starting to go into a recessionary pattern, a slowdown. And we're seeing the opposite happen right now. We're seeing a surge. A surge in mid-August is insane.
Now, so you would say that's not a seasonal condition?
That is not a seasonal pattern. It's what it says, if you look at Walmart had a breakout earnings, Target reported breakout earnings. A lot of the retail goods, consumer-driven spending is really strong in the economy. Employment's really strong. It says that what we saw in softness is likely behind us. So we're going to see really good reports from the carriers in the third and fourth quarter. I think it's going to be a fantastic season for freight. I think it's going to surprise a lot of people. Now, what's also interesting is not only are we looking at our data, because data is important, but you also have the context. We've done a lot of channel checks. I have personally spoken to 4 of the top 10 truckload carriers in the past week, and I've asked them, are you seeing what we're seeing? And they're absolutely confirming it. They said, this is really strong conditions. John Paul and I will talk about it on our weekly rate update about what he's hearing, mostly from third-party logistics companies, 3PLs, and brokers, to talk about what they're seeing. And what I'm hearing is that everybody's affirming that the market is stronger, which is really good. We're not seeing it show up in rate data yet.
Because we're oversupplied still.
We're still oversupplied. Volume is strong, and the bigger carriers typically get mostly on retail. They will get, produce is a little different.
Right.
But in the retail freight market, which is what's probably, like our estimation is that it's a lot of retail goods that are driving this.
For sure.
It's the larger carriers that become the first beneficiaries. But when they start allocating equipment to those large retail surges, then that takes out equipment that's available for other freight, and then the spot market will start to pick up from there. So it's really encouraging signs. I would expect volumes to continue to accelerate through the rest of the year, and assuming there's no sort of catastrophic geopolitical event or
another tweet
could certainly impact this. And 25% tariffs is really concerning. I hope that we're past that, but I've said it before. I don't know.
Right.
I'm not going to bet on it. But I am certainly encouraged at where we're at. Very excited. I think it's going to be a great year. Watch for spot rates to start to
really start to recover.
Recovering, well, we basically are at a flat period. We're not seeing deceleration or deterioration, but we're not seeing the levels of increase yet. But I do expect moving into the latter part of the year that we'll see some degree of firming of spot rates.
Well, yeah, I mean, the middle of the year, a lot of that is industrial production, durable goods movement, capital expenditures.
A lot of beverages move. Yeah. I mean, people drink a lot more beer and soda and water in the summer. And this summer has been unusually hot.
Right.
And so there's been a lot of that going on. We're not going to see that, but in this cycle where we move into
the retail
August
season.
Through December, that is all retail goods.
Right.
And you look at all of the big retail reports, all of the major big box retailers and e-commerce is talking about really record sales, which suggests that they got to get product.
Yeah.
This is really good news.
No, and Visa came out and said that retail for them, they didn't see any softening whatsoever.
Yeah, I am so encouraged by this. Now, it was interesting, Home Depot did come out and talk about that they lowered their forecast. A lot of it related to deterioration in construction and housing.
Which is this.
But what's good about, that's not good news, certainly if you're in housing. And I had dinner with a very large corporate company, floor covering company last night, and they said they're seeing some softness, but it's probably related to construction, which is already soft.
Yep.
The good news, there's no good news in that, but I'll take this to say most of the big construction projects happen in the summer from that Memorial to Labor Day period.
Yep.
And so that we have enough time to recover into the next year where I don't think that's going to have a huge impact on freight demand. Not a huge fact. This is what we need to watch. You need to watch consumer spending. You need to watch employment and make sure those hold up. And if they do, I would be very, very bullish into the rest of the year.
So you're calling for the end of the freight recession?
I am saying that the freight recession, as we called it in mid-May, is over with.
Wow.
And I am here to say it now. I'm excited. This number right here is what I'm watching. It's really what I watch mostly when I'm looking at the market is that volume number, because it doesn't have all the capacity noise. It doesn't have any of the capacity measured. It's strictly a volume indicator. This is the U.S. economy. This is it. If you want to know what the U.S. economy looks like, that OTVI index will give it to you. That is the freight market right there.
Trucks move it.
That's it, baby.
You heard it. Craig Fuller excited, calling the end of the freight recession.
Boom.
All right, up next we have Seth Home talking about something pretty bizarre in my opinion. What you got for us today, Seth?
Thanks, Zach. So today I want to talk about negative interest rates. So negative interest rates have been a hot topic in the financial media lately, and there's a good reason for that. So about $15 trillion in global debt now has a negative yield attached to it. That's about 25% of all debt outstanding around the globe. And so this is kind of a mind-boggling concept. It kind of goes against everything we've ever been taught our entire life about finance, how it works. Borrowers pay and savers earn. But that's not been the case lately. And so this past week, I read a blog from PIMCO. They're the world's largest bond manager. And they came up with some reasons for what they think is actually causing this global phenomenon here. And they came up with a couple structural factors and a couple cyclical factors. And on the structural side, it really comes down to technology and demographics. So if you think about technology is inherently deflationary. As the economy goes more digital, it just creates a cheaper cost of capital.
Right.
Now the second one is kind of crazy, and it is demographics. And so if you look around the developed world, you have really old populations. They're aging, right? And not only are they aging, but they're living a lot longer. So this is the crazy one where they think the entire time value of money concept may be flipping on its head. And if in your early business school classes, the time value of money basically says $1 today is worth more than $1 tomorrow,
right?
Because people like to consume now.
Right.
Well, the question is, if people, rather than living only 10 years past retirement, now they're going to live 30 or 40 years, they need a lot more savings. So it's creating this supply glut of capital where maybe people are valuing $1 tomorrow more than $1 today, and therefore they're willing to pay when they buy a bond. And so then there's a couple cyclical factors which are also weighing on interest rates around the globe, and those are more simple. Basically, the economy has been slowing down. That's a drag on yields. We had some surprise tariff announcements that weakens the economy further. And then a lot of people think that the Fed is behind the curve. And what that means is basically they raised interest rates too far, too fast, and they're going to have to reverse that.
Oh, wow.
Yeah.
So do you think that that's going to have an impact into the third and fourth quarter? Are we going to see this continue?
Yeah, so the million-dollar question is, will they keep going down? So if you look at the chart here, they peaked up at about 3.5% about a year and a half ago, and they've been coming down really steeply here to 1.74% as of yesterday.
And this is the 10-year.
That's the 10-year bond in the U.S., but we're still a long way. So if you look at Germany and Switzerland, they have negative 1% yields. So the big question everyone's asking is, are the rates in the U.S. going to eventually go negative too? Wow. And for that to happen, I think we would have to have a recession, and the Fed's basically got to cut interest rates all the way back to zero and go back to quantitative easing. But it's a fascinating thing to watch. Because
we don't think that they're going to get that aggressive in the near term, correct?
Well, if we base, Craig Fuller sat up here today and talked about the upturn in the freight markets. Sure. We've got a booming consumer, as you've seen with Target and Walmart's reports. However, it's kind of a tug of war between the strong consumer economy and the weak manufacturing and industrial economy.
Right.
So it's really going to depend on, I guess, which one of those wins out will determine the future direction of rates over the next couple quarters.
All right, interesting stuff. Thanks for watching FreightWaves Now. Make sure to hit that subscribe button and follow us on LinkedIn, Facebook, and Twitter. Have a great Wednesday.